So I'm going to talk about all this uncertainty that's surrounding us. I think I heard some groans in the room because you're probably saying, yeah, we live with it, we breathe it every day, so what's new? Well, actually it is new because the issue is that, look, think of it this way. So 8 years ago, the financial crisis kind of formally ended. And at the time, nobody thought that, these many years later, we would be hovering around zero interest rates. And that, as we know, has created a whole litany of problems for the investment world, huge amounts of uncertainty created by that alone. But now we have new layers of uncertainty that are being created by a kind of interaction between politics and economics, the like of which we haven't seen before. And so, in some ways, the job has just gotten a bit harder. You're thinking I'm pleading my cause, but you've got to take it from me that the uncertainties are higher. And we've got to really think that there's much more that we don't know than we know. And we've got to strengthen our defenses, a bit more phlegmatic. The bullets will come. We've got to learn to dodge some of them. We won't be able to dodge some of them, so how do we cope? So that's going to be the key topic. And then I'll peer through this dense fog that surrounds us and think about how markets are shaping up for the next 2 or 3 years. So as we know, last year was a serial shocker, right? So your best investment strategy last year would have been to seize on these amazing odds of Brexit happening or Donald Trump winning the US election. And let's not forget Leicester City winning the Premier League. So that's one way of making your £10 grow to whatever, right? So did we do it? No. We did think that the bookie odds for Brexit and Mr. Trump winning were far too comfortable, but we certainly didn't see them coming. I have to confess, Matthew, you won't tell me off for saying this, I hope, but I did put £100 on Mr. Trump winning the election. By that time, the odds had shrunk to 10 to 1, but it was still one of my best investments. So the issue is, do you go forth? Do you extrapolate? Probably yes, because this is a world in which the unexpected is turning into a likelihood. So find some. So this is probably the first conference you've ever attended where somebody urges you to go out and gamble. But find something wildly implausible, improbable, and put some money down on it. I don't know. What do you think we could urge them to do? Ah, yes, Aston Villa winning the Premier League, perhaps. So that's the nature of the uncertainty that we've been facing. And more seriously, of course, market reactions were huge, right, last year. It would really put a roller coaster to shame. So in the first half of the year, of course, gilt yields collapsed. Is that for real, that 10-year gilt yields got to 0.5%? But it did. It did. And then, of course, we saw this massive rise. So really, this is the stuff of roller coasters, isn't it? But that's not all. So what about sterling? And here we got a bit dizzy with sterling's rise through 14, 15. We were very discomforted by it because we thought it was taking going too far. And so from the bottom there, this is the trade-weighted exchange rate, by the way. So you won't recognize this as versus the dollar or the euro, but it's trade-weighted. But big rise. And then, of course, in less than a year, as the whole Brexit saga unfolds, of course, all that is lost and more. The really unsettling thing about all this is it's just the size of these moves and the fact that it seems so common these days. And then there's this big drama in the equity market. Now, everybody thinks, rightly, that equities bore Brexit really well. And of course, on a headline benchmark level, that is true. Equities did well last year. But look at what was going on under the scenes. So the darlings of the stock market, for years, markets had loved these bond-like equities, these stocks which were low risk. You may have heard them described as minimum volatility stocks. Markets loved them. And then the merest hint that yields were going to on the turn last summer, and they come a cropper. So investors couldn't offload them fast enough. And there's more, really, far more of this, where it comes from. But the question really is, do we expect more of the same? And the argument probably is yes, much as I hate to say it. So we don't know what the next chapter in the whole Brexit saga will be, because we've never been here before. The only country that's left the EU is Greenland, and in rather different circumstances to the UK. So we don't know. And one of them, of course, there's what Mr. Trump does. He's only just taken office. We don't really know what he's going to do. And how much will US interest rates rise? This could be a big year for the US Federal Reserve in raising rates. Again, we haven't been at zero interest rates a lot, right? So what will that do to market conditions? And then there's this hugely difficult European political calendar that's out there. 4 major elections. You know this. So the issue is that these are not self-contained events, right? They work off each other. So the whole Brexit saga impacts the way the European elections might be playing out. And it's that interaction of politics and economics and the way those risks and uncertainties interact with each other. Now, I'll put China disruption down because, my experience with these things is sometimes it's the things that hit you are the things that lurk just under the radar. And yes, China has looked quite calm over the last year, compared with where it was in 2014, 15. But, appearances can be deceptive. So in the world that we live in, we have to really look at a whole range of things. And sometimes it's the less likely stuff that seems less likely that comes and bites us hardest. So having thrown my hands up in horror at all this, we've got to think about some coping mechanisms. So what do we do? So one of the standard responses when people ask the question, how does my portfolio cope with all this uncertainty? And one answer is is time. So and the standard response, the conventional response might be say, give it time. Time is a healing balm. Give it time, my dear. It'll be fine in the end. It always works out. Just give it a bit of time. But my refrain to that is, actually 2 refrains. My first refrain is to say, but I might well be dead by then, my dear, in terms of time. And my second refrain is to say, are you absolutely sure that time will heal? Are you absolutely certain that time will sort the problem out? And what I think is important to kind of work through is that sometimes time works and works well. Other times it doesn't. And at times, time is a hugely elastic thing. How big is how stretchy is a piece of elastic? And this is a good example of how stretchy that piece of elastic became. So this is about the relationship between gilt yields and swap yields. And some of you will have dealt with the world of swaps and know that this relationship has turned upside down. But it turned, time was, before the financial crisis, when swap yields were higher than gilt yields. Does anybody remember that? No? That was the reality. And it seemed perfectly logical because swaps are supposed to price in counterparty risk of the investment bank you're dealing with going belly up. Seems perfectly logical, does it not? And then look what happens. Almost overnight, the relationship changes. And post-crisis, suddenly swaps started to yield less than gilts. And of course, the initial reaction was, well, it's all transitory, it will work out. The relationship will revert back. Well, all I can say is we've been waiting an awfully long time. And is the abnormal now the world of the normal? Who knows? I can't call this. So now some of the things that Mr. Trump is doing vis-a-vis the Dodd-Frank rules might bring some change to this because of the way swaps are marketed and made by investment banks, but I'm not in the business of trying to call that because I don't know whether that will happen or not. All I know is that time alone hasn't sorted that anomaly out. Another example, this will be felt keenly by the kind of those with a DC mindset here. So it's a question of really how long we have to wait to be rewarded for taking equity risk. So why would we put money into equities rather than bonds or gilts or treasuries or whatever? Because we expect to get rewarded for it. But the question is, how long do we wait? How long? So is it 10 years? Because we know we're told that it won't work year to year or even year to 5 years. But really, we've been waiting a long time, haven't we? Even with the second longest and strongest bull market in history, we still have to go back beyond 20 years to say that your equity risk premium has been earned. So time alone, it doesn't always work because, as we know, equities haven't done too badly for a few years. It's just that gilts and bonds have done even better. So time alone doesn't work. Now, for the DC audience, for those millennials here with a DC hat on, of course you've got time on your side. But, you know, for the rest of us, for me, for many of us in this room, time isn't something we can afford to sit and wait out on. And then here's another example where time is, you know, it's a bit of a stretchy concept. It's exchange rates. So, of course, we're told, long-term exchange rates wash out. Oh, exchange rates will mean revert. If sterling goes down, it can come back up, etc. But I think of it this way. It's certainly true. I grant you it's true that when we've had big moves down in a currency, big moves down like the one we saw last year in sterling, eventually the likelihood is that it comes back. I'll give you that. I'll give you that. But here is the nub of it, which is that here we are faced with Brexit, which we haven't been in before. So we don't know what's going to happen. So the uncertainty may delay the timing of any recovery. Sterling is cheap, but it delays the timing of the recovery. But then, the more worrisome fact here is, look at that long-term trend line. The long-term trend in sterling has been down. Can we be here? Can we be sure that that trend line is not going to hold as we look forward to the next few years? That conditions the scale and timing of the recovery, right? Last example, illiquid assets. Now, there's this tendency to think that because I'm a super patient investor and I've given up my right to sell because I'm such a super long-term investor with a super long-term horizon, I'll be rewarded for taking that illiquidity risk. But the sad fact of life is markets don't work like that. Just because I'm super patient doesn't help me. Markets melt down, as they did in the early 2000s and during the last financial crisis. Liquids fell a lot. Okay, semi-liquids, hedge funds my hedge fund colleagues will tell me off for saying this, but hedge funds did turn quite illiquid. But whatever your definition of illiquidity, the issue is that by being patient, giving up your right to sell, holding out, thinking of time as your friend didn't work. I think there's a risk that I'm going to be misinterpreted here as being negative on illiquid assets. Nothing could be further from the truth. Sometimes illiquid assets are very attractive, more attractive than liquid assets. But the issue is that time alone and giving up your right to sell isn't sufficient to be holding illiquid assets. It's the wrong reason to be holding illiquid assets. So time here is not necessarily constructive. But the issue is that there are certain things that we can do which seem to work a little bit better. And this is where a correct portfolio approach and the benefit of time seems to give you a little bit more balance to your portfolio. And it's working well in an environment of higher uncertainty. One is the simply obvious stuff. By the way, none of this is new, hopefully new to you. This just needs restating. And one of the key ways in which we can manage this risk of this very uncertain world is to make sure that our liabilities are adequately hedged. And it's just such a simple thing. And the record of having a sort of liability-minded strategy to sit alongside a growth portfolio which benefits from growth and returns, but the two working side by side has been such a powerful innovation. And it still remains the case that it still adds a lot of value. It takes out the worry in terms of the havoc that gilt yields can do to you, and it allows you to sleep more easily at night. Now, I know what you're saying, what you're thinking. Some of you will be thinking, but if I hedge now and rates go up a lot, and there is clearly some rate risk out there, then I'm going to have regret risk. Why didn't I wait? But the idea behind this approach is not to indiscriminately de-risk and hedge at all. It is just to be much more risk-minded. It's really about risk management and saying, well, if I have high conviction and I can afford to, I'm willing and able to take the risk, then I can be a bit underhedged. But I must make sure that that position is adequately sized, because if I don't, then this big bad world is going to hurt me. And this is enormously powerful and remains hugely valid for all of us. The second, again, old hat, but it's become unfashionable of late, is to think in terms of diversification across a full market cycle. Now, I know that in the last few years, because equity markets have been on such a phenomenal run since 2010, the benefits of that diversification are not always going to be obvious. And some things have disappointed, like certain hedge fund strategies have underperformed, and that's certainly true. But over a full market cycle, see, markets haven't been tested, right? We've had odd bits of correction, but markets have been generally on a run for a great number of years. So over a full market cycle, the evidence remains compelling that a diversified portfolio with ample strategic diversification will bring you lower volatility and higher returns. And this is a plea to everybody, is not just to think about how fast you're traveling, but really the quality of the ride. You know, as investors wanting an easier life in this uncertain environment, we want a smoother ride. We want to be traveling quickly as well on our journey, but we want that smoother ride alongside. Very important. Another pain relief / time impact that works well for portfolios is just currency hedging. And this is really to make sure that you're not taking unintended currency positions. So, you know, you spend a lot of time crafting your investment strategy, and then it gets massively upended by these big currency moves. And believe you me, the currency moves that we've seen in the last few years look very likely to continue with huge amounts of uncertainty. So do you want your carefully crafted investment strategy to be upended by currency moves? Now, sometimes it works well for you, because last year, as we know, currency unhedged portfolios did fantastically well, huge windfall gains. But think of it working the other way, as you should. Now, I know I've said that there's no guarantee that sterling will recover very much, or even when. But the issue is that it can work in reverse, as you see through the 2003-4 period and 2013 periods. So it can work very much the other way. So those gains that you've pocketed, that we are so pleased to get over the last year, would then be in danger if the currency recovers. We don't know when, but chances are that it probably will. And then those gains will be put at risk. But the bigger issue is not so much the return angle. It's really the question of really unintended positions around currency, which may not be at all what you intend in terms of putting down an investment strategy in the first place. And my final pain relief measure is really thinking about again, the way I began, it's thinking about the implausible. Forgetting those behavioral biases, and I should know because I have them in plenty, is putting aside those behavioral biases. You know, I think A is more likely than B, and B is more likely than C. But in this strange old world that we're in, there's much more about the don't knows here than the knows. And really what I'm going on here in this slide is using scenario analysis to plan for what looks like the implausible. And we found that because of heightened uncertainty, this is a very powerful tool for putting aside those behavioral biases and saying, you know, I might think the world of high inflation is very unlikely, but what if I'm wrong? What if I'm wrong? What does it do to my assets and my liabilities and my funding levels? You know, it's a lot more intuitive than the kind of standard high-tech modeling approaches that I'm sure you know about. In a world of uncertainty, this works better because it's much more intuitive. Uncertainty isn't something that we can model very easily, particularly. That's part of the problem. So risk is modelable with kind of lots of high-tech bang-wizardry around statistical models. But uncertainty modeling is a bit different. And what scenario analysis does is allows you to really ask some of these difficult what-if questions and get something that's internally consistent, logical, and that you can follow through. If you get some time, I think it appears on the risk analyzer tool that we have. And so if you've got a few minutes in the break, have a look and see what works. We've given you a couple of examples of some of the Brexit paths that we've been working with. At the moment, of course, this is where behavioral biases come in. So we would say, oh, well, the smooth transition is looking a little bit less likely than the other one. But that's not the point of the exercise. I wouldn't assign any probabilities to this. I would just look at the funnel of doubt that you get in terms of what the ranges are and plan accordingly. And those are 4 kind of what we would call pain relief measures, which should help you ultimately to cope with this scale of uncertainty that we see around us. So let me summarize the conclusions in terms of the uncertainty aspect. So risk is always present, but this is uncertainty we're talking about. There is some pain relief that's available through some of these very simple, very straightforward, low-tech ways of insulating portfolios. And the ultimate plea is just the behavioral one, which is don't dismiss the unlikely. Don't let past thinking, because our previous knowledge and experience is probably not very helpful at this point in terms of looking at the world as is. So in my last few minutes, before Matthew throws me out for the stage, I want to just look at some of our key market views and in terms of what's shaping up over the next 2-3 years. So there's some good news. The good news is the world economy looks a lot better than it did 6 months ago. So if you look at the green line, you will see what I'm talking about. So the middle of the year, and really, if you were thinking Brexit time, why did markets panic so much around Brexit time? Albeit the panic was brief. It's because the global economy looked quite shaky, and at the time it was feared that Brexit would be the trigger that would tip the global economy into potential recession. Well, luckily we dodged that bullet, and in fact things have looked better. Now, this doesn't mean that the improvement will last, but it's just that we've moved on, and the risks of Brexit or some of these other events taking the world economy into recession, for now, look much better. And that's something to hang on to. It's, by all means, not all gloom and doom. But you will see from the blue line, though, that inflation has started to pick up. That's one of the side effects of this improvement in the global economy. Before, it was a kind of deflationary slump that was being threatened. We've moved off slump conditions. Inflation is beginning to normalize. How does this translate into UK economic conditions? Well, the most obvious high-level thing to talk about here is that Brexit is a slow burn process. It's a slow evolution with huge uncertainties on how the path evolves. Very little visibility. But a couple of things are starting to emerge. One is that the big fall in the pound is now coming through in somewhat higher inflation, and that is at the margin taking some steam out of the UK consumer. And we have to thank the UK consumer for being very supportive of the economy over the last 2-3 years. But the fact is that as inflation is picking up and there's more to go, now we don't think inflation will be sustained at particularly high levels beyond the next couple of years, but we're really talking about inflation above target, 2.5% to 3%, consumer price inflation, add a little bit around under 1% to get to RPI. But the issue is that will probably exceed wage growth and earnings growth, and so the consumer will slow. Alongside what's happening is that business investment intentions, which we show by the green line, the business investment. This is, by the way, taken from Bank of England's agents who go around the region surveying businesses. And basically the message from that and a lot of other business surveys is that business investment is likely to slow. And that's hardly surprising because we don't know what the terms of engagement with the EU are. 40 years of trading relationships being upended with huge amounts of uncertainty. So business is going to hesitate. And so the impact of Brexit will be that overall growth is going to be a little bit slower than it would otherwise. It's not disastrous. And we might, if things work out well over the next 5 to 10 years, we could still be in sunny uplands. But at the moment, unfortunately, I can't look beyond the next couple of years because of the sheer scale of uncertainty out there. So what does it mean for investment markets? For the UK, it means that interest rates will be slow to rise. They will still be rising over the next 3 to 5 years, very gradually, albeit, but they'll still be rising. What we show you here from a gilt yield and hedging standpoint is what the market is pricing by way of gilt yields. And you'll see from the green bars, these are 20-year duration gilts, and you'll see that we Market's pricing a modest rise. Remember, gilt yields have already risen a fair bit in the last few months. Market's pricing those yields to go a little bit higher. We've got a little bit more going on top. Not a lot, but a little bit more going on above that. The issue is that that gap between what we're expecting in the markets is not small enough to suggest that it makes a great deal of sense and it's very remunerative to be very underhedged and to really stick your neck out on interest rates. It doesn't look to be that sort of world. For those more technically minded among you, there's a bit of a difference in terms of our views, in terms of the real component and the inflation component of yields. We think that the real component has the bigger adjustment to make. The inflation component of yields, in terms of what you might have heard to refer to as break-even inflation, already looks quite high. So it's the real component that needs to rise. But overall, hedging very much still recommended. Small amount of tactical underhedging, okay, but hedging generally is recommended. Moving on to investment-grade credit and corporate bonds, it's seen better times because spreads are now at levels which we are not particularly keen on, a bit below our fair values. Not disastrous. We would regard that as a quote-unquote a hold, but not a buy. Particularly in terms of interest rate risk and where that credit spread is, it doesn't look attractive. And it really makes a lot of sense, as we've been saying for a couple of years, to think about going global. If you've got significant holdings in sterling corporate bonds, go global because opportunities are significant outside the UK. And the sterling corporate bond market is increasingly threatened by illiquidity because issuance, which has been dwindling for a few years, potentially post-Brexit could dwindle further. And that challenges that market's functioning. So quick word on equities. So the good stuff on equities is that it still continues to look good versus bonds. You all observe dividend yields out there, and dividend yields remain higher than gilt yields by and large. That is very commonsensical, intuitive argument behind the relative arguments of equities versus bonds. We do a slightly more sophisticated calculation of the so-called expected equity risk premium, and that still remains in buy territory. So on a relative basis against fixed income, equities look good. The less good news is on all the other stuff, which is around valuations, which still look high in that very important US market. And then we've got all the uncertainties around what's happening in Europe, what's happening with Mr. Trump. Some of Mr. Trump's policies are stimulatory for the near term, but that feel-good factor could very easily disappear if he launches into more protectionist policies, which really is a prospect. And that is concerning for us. And this uncertainty, high-level uncertainty, keeps us a bit less than enthusiastic, that we recognize that things look a bit better than they did a few months ago, that's for sure. And finally, just to summarize where to invest. Yes, supported equities near term. Cheaper regions, cheaper style, generally is better in this particular environment. Gilts, expected returns, the return profile looks poor, but from a hedging standpoint, you've got to say there isn't very much here to take a big view on rates. Credit, it's a going global viewpoint, and within alternatives, emphasize the benefits of diversification. Return infrastructure looks good, particularly with an likely expansion of opportunities. And of course, there are other absolute return strategies. If we had more time, I would talk to you about it. Currency, it's a good time to hedge, for sure. And from a personal investment standpoint, go out and gamble. And I'll stop there.